Well, welcome everyone to week 8. Only just a couple more sessions to go here. Tonight we'll be covering chapter 10, which is on capital investment and financial risk. Chapter 10 is probably the hardest chapter to teach, and also it's probably one of the most challenging for students to learn. People tend to ask as far as when they do the exam about the amount of calculations and what will be on it. For those that have already read the chapter, there's two ways of doing this. There's the formula, which you'll want to memorize, but then there's also tables. And in some cases, they'll provide the tables, but you need to be able to know how to do it both ways. The other question I typically get about this chapter is, well, it's actually more about taking the test, is you can take the exam in segments. And there's segment A, B, and C. And so people like the idea of doing the segments, which is great. The problem is when you do the segmented exam, the segment A and B are fairly easy, and you still have to pass with a 70%, and it's based upon the chapters that are in there. Well, segment C, because it includes chapter 10, in this case, if you bomb this chapter, when you do segments, you might fail the entire exam. Whereas if you take the exam as a whole and you don't do it in segments and you bomb it, you can still pass the test. And the rationale behind that is you're dealing with 85 questions to pass at 75% compared to only 3 chapters. And so that's where that comes into play there. So generally, I do recommend that you actually take the entire exam so that if this does become a challenge for you, you can pass it. And I have had people that have passed the other two and have just not been able to, to figure out the chapter 10, and they've taken it 2 or 3 times in order to finally get their ARM or pass the ARM 54. All right, so tonight, what are we covering? So pretty much everything's a calculation that you look on here. So given a time period and discount rate, calculate the present value of an organization's future payment. And then given a risk manager's payments over a period of time at an applicable rate of return, calculate the present value of an annuity. And then an individual stream of unequal payments and applicable rate of return, calculate the present value. And then given a rate of return to discount cash outflows and inflows, calculate an investment's net present value. And this part's probably the most challenging, is that bullet. Using the net present value method, evaluate an organization's capital investment proposals. Given an accident analysis of accidental losses and loss control techniques, calculate the net present value of an organization's capital investment proposal, which is kind of similar to the one above. And then finally, given an organization's prices and operational results, calculate the effect on net income of a call option that offsets input price increases. So, like I said, everything is pretty much a calculation that you're going to have to do in this. So, in some respects, it's kind of easy. The good news is that the questions do not build upon themselves. So, you're not going to have a scenario where the answer that you get prior is going to come. You're going to have to use that calculation to figure out the next question. They're all going to be independent when you do this chapter. All right, let's get into it. So present value and discounting, what is it? So present value is the idea that the value of money that will be received in the future, right? Is if we're going to receive $10,000 over 10 years, how much is that per year? And if we, what is it in present value dollars? Because the idea is that you're going to, if it's invested, you'll be paying less money if you kind of hold it. And that's why interest rates and discounting is important. It's also the definition, sum of money to be received in the future depends on the rate of return it could earn if it were received today, and the number of periods over which it would earn that rate of return. Again, for those playing lottery, those type of things, this if nothing else, this is the lesson on when should you take the cash, the total cash, or do you want to get it as an annuity period over time? This is basically the idea of present value and discounting. Discounting, process of calculating the present value of a future amount, and the discount rate is the rate of return used in determining the present value of a future sum. Now, typically the discount rate, another way to think about it, is really the interest rate of what we're expecting. but when we do present value, it's called the discount rate, but it's kind of the idea of the same thing, is how much money is that money that's sitting aside, is it going to earn? And so the discount rate and the interest rate are kind of the same thing when we look at it from that perspective. So when we talk about present value of money, there's some things I include that aren't necessarily in the book, or that used to be in the book, that I think are good to include. So that way you have a better understanding of kind of how this works a little bit. But the idea here, when we talk about, there's an inverse relationship between the present value of a dollar and the time period until the single future payment occurs. And as the time increases, the present value decreases, as well as the discount rate for any given time period. The higher the discount rate, the lower the present value. And so the figures down below kind of illustrate that if time period 0, which is now, the dollar that we have in our hand, it is a present value, it's worth $1. But in 1 year, at a 10% discount rate, it's worth 0.91 cents, or 91 cents, I should say. After 10 years, 39 cents. And after 50 years, it's worth 1 penny. So again, that's based upon the interest rate. At the same time, if we say something that's a discount rate earning 10%, the value after 1 year is going to be the same thing. It's 91 cents. If it's 12%, or if we say 50%, let's say the discount, that it would be worth 67 cents. So essentially saying, if we have 67 cents now and we had an interest rate of 50%, essentially after 1 year, another way of looking at it would be that dollar, that's what it's worth based upon, again, that discount. It's kind of the inverse relationship there. Hopefully that made sense to you with that. But the idea is that if I invest 67 cents now in a year at 50, and I had a 50% interest rate, essentially it'd be worth $1 after the year. So that's where the same type of thing, if you go what the present value of it is now. So going right into calculations, since this is what we'll be doing pretty much all night, and this is where the chapter goes, right into formulas to take a look at this, is we do have the formula up in the upper left-hand corner. We have present value equals the future value over n period of times divided by 1 plus, this is the rate of return, right? So the rate of return, so R, and then N is up above. It kind of looks hard to see there, but that's essentially the number of years that we're going to be doing the calculation for. So in this case, we're just going to be doing a single period. So this is probably the easiest question you'll have on the exam. And remember, it's asking you on the objectives that you're going to have to be able to, given this example, calculate. And so you're going to have to do this, expect a question or some type of problem for each one of these. So the example they give us, assume that at the end of 1 year, an organization needs $10,300 to be in a savings account that pays 3% interest compounded annually. The financial manager must determine how much to deposit in the account today to have the required $10,300 in 1 year. So that is the present value of $10,300 discounted at a rate of 3% for 1 year. And the answer can be calculated using the following present value equation. So we're using the equation up above, and they essentially insert the information in there. So we know what we're trying to figure out is the present value. How much money do we need now to invest to get $10,300 at a 3% interest rate? So knowing what we need in the future, we're going to say $10,300 divided by, so 1 plus, then 0.03. So 3%, going back to, is the same thing as 0.03. We would then, exponent by the number of years. So in this case, it's 1, so it stays the same. So 10,300 divided by 1.03 equals $10,000. Now, you could have done this all probably in your head and said, okay, 10,000 times, what's 3% of 10,000? What do we need to, if that, and probably just figured out in your head that that would be the same thing. A lot of the problems on here, the math is going to be simple enough. In many cases, you probably can do some of it in your head, or at least be able to determine what answers are right and what answers are wrong, because again, it's going to be multiple choice. The good news, as you go through this, you'll be able to see some of the answers and say, okay, do these answers even make any sense to be able to do that? So that's easy, right? We have 1 period. We say after 1 year. Okay, that's an easy one, and that's something we probably do on a regular basis. Now we're going to the next set of questions are on here that we have to be able to do is calculate over a period of time, right? And so, or for multiple periods. So in this case, the example they give, and again, it's the same, pretty much the same formula that we're getting. So the financial manager must choose between receiving full payment of $11,910 in 3 years or accepting a reduced payment today and full settlement of the receivable. Assuming the money, if received today, could be deposited in an account that earns 3% interest for 3 years, what is the smallest amount the financial manager can accept today to make the second option an acceptable alternative? The decision made by calculating the present value or discounted value of $11,910. Now, when they give these word problems, and you will have some problems like this, you just really have to decipher what's really the important information there. And we know full payment, $11,910, that's what the value we want in the future. And then the other really important information is the 3%. All the problems are not, it's always going to be compounded, or it's going to be on an annual basis, not compounded daily. So that, again, makes it easy to do some of these problems. Again, this is straightforward. So we insert the future value, 11,910, divided by 1 plus 0.03 into the third power, right? And so when we do that, so 3 to the third, and we come up with 1.0927, and divide that out, and we come up with $10,899. So essentially meaning the lowest amount that we could receive and able to come out equal or reduced payment today in full settlement would be $10,899. Now, I kind of went back to the lottery and those type of things. Sometimes you see commercials on TV saying, if you have an annuity or you have a settlement, we will pay you cash today, and so that you don't have to wait to get that money over a period of time. And essentially, this is what they're doing, except they're giving you a lesser of a deal. What they're betting on is they're going to give you a certain amount of money with the hope that they will earn more interest than what you would have or what that annuity would have been paying. So that's where this comes into play. They're going to give you less money than as an example. Maybe they give you $7,000 with the idea, hey, you have cash in hand, and they will be the ones making the money off of that annuity by doing it that way. So we've looked at the equation, but the textbook also provides tables. And so you need to be able to do this in both formats to be able to figure this out. So in this case, instead of dividing, the formula is, it's going to be the future value times the present value factor. So in this case, what we're looking at is, we said it's a 3-year period, right? And the interest rate is 3%. So we come down here and we see 0.9151. So if we multiply 11,910 by that 0.9151, we come out with the same answer. When I was doing the exam, a lot of times if there was with the table, I would do the equations both ways. That way I just made sure I got the right answer. You don't necessarily have to do that if you're more confident, but that was a way to make sure that, yes, I'm coming up with the same answer based upon either using the table or the equation in doing so. So we kind of talked a little bit about the multiple period of time. Now we're going to talk more specifically about present value of an annuity. And the annuity is really just a series of fixed payments made on a specified date or dates over a set period. Again, lottery, over 30 years. If you want $1 million, you're going to get a set amount of money over a period of time over that 30-year period. So future disability. So why this is important for risk managers, one is if you have settlement payments for maybe future disability, a compromise and release, those type of things, because you can actually buy an annuity to make future payments for that injured employee, or if there was a liability claim. Those are the type of examples where you might use something like that. So, and this is a good example when we use some small dollar amounts, but the example that they provide here. So suppose a manager is offered payments of $750 at the end of each year for 3 years in satisfaction of a current account receivable of $2,100. Well, on the face of it, that sounds like a pretty good idea because 750 times 3, well, that's what, $2,250. So I'm actually going to, instead of paying the $2,100 now, if I pay the $750, as a person receiving it, I'm going to get more money. but also assume that the $2,100 sum, if received today, could be invested and earn a 6% rate of return. And this is where opportunity cost comes in. So the opportunity cost of receiving payments in the future rather than today is 6% per annum. So all these things we talk about when we talk about future payments and interest rates, it's about the opportunity cost of receiving the money now and what that value is. And so that's why this present value idea is so important, especially when it comes to insurance, because usually these payments can be over a number of years. And the idea is, do you receive it now at what interest rate, or if we're buying equipment, how long is it going to last? Those type of things, if it's going to help our operations or reduce, insurance costs. So with that, again, easy little figure in there. Well, why we might have 2250 up here, if we do this each year, we say 750 divided by 1.06, right? And the 0.06 again is the present value, the interest rate, discount rate 0.06. In this case, it's only 1 year, so it is what it is. So 708, and then we go 1.06 to the second power. And when we figure that out, 668, and we go through. So if we add up all these years, the present value of 750 over a period of time, based upon a 6% discount rate, is about $2,006. So you can kind of see where that now comes into play. That 750, would I rather receive $2,100 now or 750 over a period of years? Well, I can invest that money and make more money at that 6% interest rate than if just by taking those $750 payments each year. Another example, again, showing both ways of how to do this problem. So present value of annuity, that's where the PVA comes in, and all we're doing is what really the annuity and the present value of the annuity in the future. So, this is the amount of the payment, excuse me. So in this case, 750 is the payment. And then what we said was, 3 years at 6%. So if we go over here, 3 years, and let's go over to 6%, we see 2.6730. There we go. And multiply that, and we get the same answer, $2,005. Again, that's just how you want to, you can do it both ways, and this is the way we can double check our answers when we do this type of problem. The challenge is now, what if we have unequal payments? So in on the objectives, we said, of equal payments, calculate the present value over a period of time. One of the other things now is we have to figure out, what if they're unequal payments over the period? Well, this one's a little more challenging because you can't use the standard formula. We're going to have to calculate each year on its own. So what you'll see in here is now, so they're just using the 250, 300, 500, 700 as an example in this. So the first year, so year one, and we are now assuming, again, a 6%. So year one, we'd multiply the $250 payment times 0.9434. Year two, 89.89. Year three, and you can see how this just flows down. And so you actually have to set up the problem this way, where you're going to do year one, year two, year three, and basically solve for each year. You're never going to have more than 4 years on the exam. So again, it's going to be fairly simple. And the numbers that they're going to use are going to be fairly simple as well. You just have to know to go back in the textbook. You just can't use just one value. You're going to have to do each year individually and add them up to come up to the answer. So now we're coming up to net present value, right? So we've talked about present value. Now we have to do the net present value. And so the present value, and this is really talking more about cash flows, right? So the present value of all future net cash flows, including salvage value, discounted at the cost of capital, minus the cost of initial investment, also discounted at the cost of capital. So a lot of information in there. And so we're going to show you how to really set up this type of problem. And they do this very well in the book. So what we're leading to is we talk about, how do you use the tables, do the calculations for present value, and now we're going to look at it for net present value. So there's a little different, when we talk about PV versus NPV. And for those that have done either accounting or some other type of classes, things like this, this should be fairly simple for you, but this usually does scare a lot of people away of doing these type of things. So in our formula, we have cash flow at the beginning of the project, which is C0. And then payment, and then we have CT, which is payment at a period T for T1 through TN. So depending on how many years, right? That's how many payments, payment one, payment two, that we're expecting during that period of time, what our discount rate is. So again, R is going to be our discount rate, and N is for the number of periods or number of years, months, depending on the way that looks. The problems typically, whereas I've taken other exams like the CSP exam, they would put it in months, and then you had a thing in years, and you'd have to convert and all that. Your problems you're going to find on these exams are going to be straightforward. If it's mentioning years, it's going to be a straight line years. You're not going to have to do conversions. It should be fairly simple on the problems. So it's going to be something like this, right? So, and this is the type of problems that you're seeing in the textbook. They really are going to be give an example, for example, or they're going to give some background information. There'll be some noise in there sometimes, but for the most part, they'll be fairly straightforward, and you just want to kind of figure out what this would look like. And you do really want to memorize like the equations, at least for net present value, the way those would work there. So in this case, for example, assume that a risk management professional is determining whether to invest $10,000 today in a 3-year machinery maintenance project. All right, so $10,000, that's our initial outlay, our initial cost. And then we also know this is 3 years that we need to look at this project. The company requires a rate of return of 7%. Now, I'm just going to point out the reason why that 7%, it says a rate of return. So that's kind of your interest rate, discount rate that you're using. And really, when it says the company requires that, that's really their opportunity cost. What they're saying is, if we're going to buy other things, we want to have a savings, or based upon this rate of return, of 7% of whatever we invest in. We need to have at least that minimum, because we can earn at least 7% doing something else with that money. And so that's why the rate of return is important when you look at these problems. Further, assume that it expects to save breakdown expenses of $2,500 at the end of the first year, $3,300 at the end of the second year, and $4,700 at the third year. Now, again, it's expenses. It's saying it talks about expenses. It says expect to save. So that means it's an increase in cash flow, because normally we might have breakdown expenses, but now we're having less, and so that's a savings that we're going to put on there. So if we put this into the equation, so we have initial cost of $10,000, year one, $2,500, and we see all this information's up there. And so if we did a straight line, if we add all this up, we'd say, well, $10,000, and it's undiscounted, right? Key keyword is undiscounted. We're not using interest rates or anything else like that. Is that it looks like we have a net savings of $500 just by doing a straight line without doing any discounting. But when we do it normally with the discounting, we're going to take the first year. So $2,500, again, this is initial savings, a 7% rate of return. That's what we're expecting. So times the one in the first year is 1.07 times this, and we come up with 23,336. And then 1.07 to the second power, right? And then we divide, we'll come up with 28,882. And the same thing, we do it for each of these years. We, in this case, this is negative 10,000 because it was our initial outlay, and add our costs, and we come up with that this machinery project will actually lose money, right? It's not going to earn, it's going to be negative $945, so it does not meet the company's required rate of return. Now, and this basically kind of shows, this is the same thing of how you can basically do the problem. The other way, you have your present value factor. Again, what we try to do is show how to do it both ways on here. And so if we say year one, so we have year one, and what do we say? 7%, 9,346, year two, 87. So you can do the same problem both ways. You're going to come up with the same answer. So I really try to show how you can do that. So depending if you're going to use the tables or what information they provide you with, you should be able to do the problem either way. So now that we have kind of the basics, right? We've covered, essentially how to do present value calculations. How much is a dollar worth, now based upon our future payments, and also net present value over a period of time to be able to calculate what's the proposal. And really, again, net present value, all that means is we're saying there's a cost, and then we're going to have some savings, and we're going to subtract those the savings from the initial cost, and that comes what our net present value is. This becomes important when we start looking at investment proposal. Just as the other problem said, we're looking at purchasing equipment. Now we're going to look at like bigger outlays. And so, and capital budgeting, when you have to go to the CFO and explain why you want to spend money on certain things. So from capital budgeting, what is that? It's a process for evaluating alternative capital investment proposals in terms of the cash outlays that the proposals require and the present value of the cash inflows that the proposals are likely to generate. We're going to look at long and short-term outflows of cash as well as cash flow, determine if investment proposal expected to produce cash flows with a present value greater than the amount invested. Now, this is why it's important when you say, I want to spend X amount of dollars on a piece of equipment or buy shoes for employees as for safety shoes or something like that, is because there's going to be outlay and you have to say what the savings in. It's real easy, as we kind of saw, that, if it's undiscounted, yeah, it looks like we save money. But what the accounting and the financial team is, they're going to want to have it with a discount rate in there because they're going to have an internal rate of return that they're going to expect. So operating expenses, disbursements for assets that will be consumed in a relatively short period, usually within 1 year or single accounting period, whereas capital expenditures are for assets that will be consumed over a relatively long period, usually multiple accounting periods. So operating expenditures, supplies, paper, pencils, all the office supplies, anything, fuel, that's on a daily. Again, get the idea of operating. Where capital, a car, it's capital expenditure. It's going to be, and usually with capital expenditures, you have to account for its useful life, right? And how many years. And so you're going to see that as we go through some of the problems here. So when we use the net present value method to evaluate cash flows, what we're trying to do is we're going to calculate where the present value of a proposal's net cash flow is positive or negative at a specified interest rate. Now, again, the interest rate is going to be set by your financial team or your finance department. And depending on what that rate is, could be whether there is a positive cash flow or not. And you'll see some examples of that as we go through here. So one thing to expect on the exam that is not a calculation is a question that's going to ask, what information do you need to evaluate a capital investment proposal? And here's the 4 things you need to know. The amount of the initial investment, the acceptable annual rate of return, the amount and timing of the differential incremental annual after-tax net cash flows associated with the proposal over its estimated useful life. Okay, a lot of words there. The timing of differential incremental, meaning over a period of time, annual after net cash flows, and its estimated useful life. So how long do we expect this piece of machinery to last, and what are the inflows expected or the cash flows associated with that? And the salvage value of any of the investment. Typically, on most of the questions, they're going to say there is no salvage value, but the idea is at the end of, let's say you buy a car and you have a cash flow, if you sell it, it's going to have some type of salvage value, which you can include at the very end as part of the overall savings of the proposal. So in this problem, they're going to give, here's a basic example of what this would look like. So they'll provide factors, and you may have a problem that looks exactly like this. They'll provide it framed up in here. So initial investment, in this case, is $30,000 for whatever piece of equipment. A useful life of 3 years. Differential annual after-tax flow is essentially we're expecting this piece of machinery to help improve our operating efficiency, and we'll have some savings. We'll actually have a net inflow because of this of $12,000 a year. And the minimum acceptable rate of return is 10% annually, right? So the way we can look at this is, and what I encourage you to do on these problems is actually, you're going to get either a piece of paper or whiteboard when you take the test at a testing center, is to actually kind of pencil out, right, what this looks like of 37 outflow, 12,000, year 1 inflow, 12,000, 12,000. So you can kind of get a visual of what this looks like as well. And all that we're looking at is the present value sum of the future net cash flows minus the present value of the initial investment. Okay, and so when we look at the problem, so in this case, by doing the net present value method, the present value of differential inflows, the 12,000 a year, times the 2.487, that's coming from our table, right? So we're saying 3 years at 10%, 2.487, and multiply that out, we come with 29,844. That's what our inflows are. Our outflows, what we had to do, the initial investment was 30,000, meaning we have a negative $156. So basically the rate of return at that 10% level is we don't have a positive cash flow. And again, that's what I talk about, is really about opportunity cost, where we could have earned that money. Now, if our corporate finance department said, we only need a 6% rate of return. Well, what happens to your positive cash flow? Well, now we come up, this answer becomes 32,706. And so we end up coming, it would be 2,706 to the good. So when we look at evaluating capital investment proposals, that discount rate or the rate of return is really important to determine whether it's going to have a net cash flow or a savings as seen by the finance department. So, all right. So even though you're not going to be coming up with the rate of return that's going to be given to you typically by, like I said, your finance department, there is discussion in the textbook about, what does that mean? The risk return trade-off. And the idea of something that's more risky is going to have a higher rate of return, right? That they're going to want to see a better investment return on some of those type of things. And that's where we kind of come up with some of the trade-offs there. So the risk return trade-off, the tendency for the potential return to increase as risk increases, right? So it requires investors to determine the appropriate balance between assuming the lowest possible risk and achieving the highest possible return, and helps determine the minimum rate of return. Probably not so much on the exam, you have to worry about it, but it is just important to know that based upon the risk, the proposals, that's what they're looking at and setting up that minimum rate of return. And then the differential or incremental annual after-tax net cash flow is the change in the organization's aggregate annual net cash flows resulting from implementing a proposal. So you do want to know that definition. That will most likely be a question on there. And then straight line depreciation method. Everything we're going to be doing on the exam is going to be straight line depreciation. Basically, and it talks about accounting method of calculating depreciation by taking equal amount of an asset's cost as an expense for each year of the asset's useful life. So if we had a $10,000 piece of equipment and we say it has a 10-year useful life, that means the depreciation method straight line is 10,000 divided by 10, and that's $1,000 as we can depreciate. For those that own their own business or have to do depreciation based on equipment, this is something that's standard, would be the straight line depreciation method. This is where people get scared. Is doing, when they see this in the textbook, is the cash flow analysis of a risk management information system. The good news on the exam is that you're only going to have to figure out the top part or figure out the bottom part. You're not going to have to do everything all in one question, because they're going to look to see if you understand the steps, at least as far as doing kind of each element of it. So you're not going to have questions that build upon each other. They're going to be set alone, where you're going to have maybe this bottom part, some information, and you'll have to figure out, the net present value on it. So the information they give us in this case now is we're taking that $12,000 and looking at the initial investment and looking at it from this from a cash flow perspective. So in this case, the revenues, the cash revenues we had are about $12,000 a year, right? And one thing that it does talk about in this example and that they provide in here is that the machine will add $500 annually to the organization's operating expenses and $100 per year to the property insurance. So we buy this piece of equipment, it's going to cost about $500 to maintain it, and another $100 for insurance. So that's $600. Well, we're going to deduct that from the revenue, so the $12,000, because that's taking away our profit, right? And so before tax net cash flow is $11,400. Okay, we kind of move this down. Now that's kind of the first step. The next step is what we're looking at is now we want to figure out what our after-tax next net cash flow is. And the way that we do this is we say, okay, we have our expenses. We're left with $11,400. Now, when we look at the piece of equipment, it costs us $30,000 and it has a useful life of 7 years. So if we divide 30,000 by 7, that means each year we can depreciate 4,286 off of that total amount. And so when we do that, what that allows us to do is take the 11,400 before tax net cash flow and reduce it down. So our taxable income is now $7,114. And this is, you kind of see where the things kind of line up on the chart here. So now we take this amount, and this is where, again, people kind of start losing it here, is that now it talks about income taxes, right? So now we've depreciated. We said this is what our net cash flow is 7,114. And now we multiply this by the 40% to come up with, what we have to pay in taxes. And it shows $2,846 in taxes. And what we're going to do is take this 11,400 and subtract what we're paying in taxes. And so our after-tax net cash flow is $8,554. So walking through this again, so you can see $12,000, our annual income that we're expecting. We have $600 in expenses. We deduct it. We now take that and we say, okay, let's depreciate the value and subtract that. We come with 7,114 and then multiply that by whatever the income tax is. Most likely on the exam, it's almost always 40% as well. And come up and subtract your income taxes that you're going to have to pay from your before tax net cash flow. And then you come up with your after tax. The way I recommend is you get this information when you see this on the exam is it might be a word problem, and set up the problem similar to this. Say what's coming in, before tax, net cash flow, what's your expenses, and then now you subtract the income taxes, and that will help you kind of think through the problem. Also, on the website, you're going to find 29 pages of sample problems that you can go through so you can practice this. And feel free, you can always email me if you're having problems with this, and I'll be more than happy to call you and walk you through some of the problems one-on-one if that's something that might be helpful for you. All right, so we did the first part, which is the cash flow analysis. Now we need to evaluations of the annual net cash flow. So this is kind of the second step or another part of a problem that you're going to get. So now we come back with our initial investment of $30,000. This is the information that they usually provide. Useful life 7 years. Annual after-tax net cash flow. This is what we figured out. And minimum acceptable rate of return now, we have this number here that says it's 8% annually. So based upon this, present value of 8,554, 8% over 7 years is going to be 5.206. So if we went to the table, that's where that number is coming from. We multiply it out. We see that the net present value is $44,532. Our initial investment was the $30,000, and we show that our net present value basically is $14,000. So this shows that on an annual basis, our net cash flow for buying this piece of machinery does pay for itself. It does meet our internal rate of return by doing that. And so the recommendation would be, yes, let's buy this. It makes sense. We're making money by doing this, and it meets the internal rate of return. I put on the slide that what if you're a nonprofit? Well, it's the same idea. Well, it might not be a profit situation. The idea of in doing this, a nonprofit would want to do this as well because it's about savings. It's about implementing a sprinkler system or something like that that would actually have a savings for the organization. So when we talk about net cash flows and why is it important, they're subject to uncertainty risk, right? So risk needs to be considered when choosing discount rate and minimum rate of return. This is where it comes back from the finance team. They're going to give you that, but this is part of what needs to be looked at is what's the uncertainty? Do we expect to have a rate of return of a certain percentage? The higher the uncertainty of future cash flows, the greater the minimum required rate of return. Right? So if we're uncertain on our future cash flows of how much money we're going to be getting of let's say the $12,000, we're not quite sure, then you want to have a higher rate of return to basically offset that uncertainty. So again, the higher risk should be higher rewards. And then sometimes they don't do this, they're not going to have it on exam. You can factor in a cost of uncertainty or a risk premium that would go on top of that. And then it talks about sensitivity analysis. It's a method to investigate the effect of change in one or more variables on the results of the financial analysis. You're not going to have to do that, but they just mentioned that in the textbook. So case facts. So this is where when you take the exam, you're going to have some problems. They're going to be fairly straightforward. with just a simple question, and then you're going to have something that looks like this, where it's a case study, and it's going to be for 3 or 4 questions, and you're going to have to pull out information that they provide there of what's important. So we'll go through this. So Artwell Hospital, or Atwell, is considering using one of its buildings previously leased as office space to house the James Research Center, or JRC, which will be run by Dr. James, who's well known in medical research. Okay, so here's the case facts. The expected life of the project and length of the proposed contract are 10 years, right? So 10 years, that's important to know, because that's what we're going to look at on the table for how long, from a discount rate standpoint, also for any type of depreciation when we look at what the investment is. The hospital projects that its association with Dr. James will yield an additional or differential, right? When we talk about additional money, $60,000 in annual revenue compared with its prior net revenues from leasing the building. So $60,000, that's important. That's what they're expecting cash inflows to be. In addition to providing the building for the research center, Atwell will provide Dr. James with a $200,000 grant to help establish the research facility and obtain necessary equipment. Again, $200,000, so that's the outlay. That's what the investment is. Then it says the $200,000 grant is depreciated over 10 years on a straight line basis. Yeah, that's important, because we use $200,000 divided by 10 to come up with our depreciation of $20,000 a year. The chief financial officer of Atwell has told the risk management professional that the minimum acceptable rate of return is 10%. So now we're looking at 10% over 10 years. So that's what we're going to look at on the table. Because of the use of volatile chemicals in Dr. James' research, the primary property loss exposure attributable to JRC is the risk of physical damage to the building from fire. Atwell's management has asked the risk management professional to consider only the property loss exposure from the fire and no other property or liability. So this is their disclaimer that you don't need to worry about other stuff, just based upon the information provided to solve the problem. And then based upon the proposal, the hospital is not responsible for any damage to the buildings, contents, fixtures, those type of things. Again, so you don't have to account for that. So this is one of the things where it's looking the capital losses, or to be able to evaluate potential proposals. So what they're providing in the book, and they try to think if I don't remember this being on this part of the exam. They usually provide this, but the idea here is they're looking at the probability of an annual fire loss to come up, and this is kind of giving an idea where this 16,000 is coming from. And where this is coming from is the probability of a fire, 80% chance that there'll be no fire at all, which means there's no loss. A 10% chance of a fire that results in 30,000 damage, 7% of 100,000, and 3% of 200,000. And so when you do the expected value, you're just multiplying across 10% times 30,000, and we come up with expected value of 3,000, 7, and 6, which over, so the annual expected loss value based upon this is $16,000. Again, you're probably going to be given this, but you want to make sure you do know how to do it just in case it is a problem on it. So why is this important? So again, we pulled out the numbers. Cash revenues. What they said in the proposal is that they expect this new venture by Dr. JRC is that it's going to have cash revenues of $60,000 a year. Now, what they put in here is also they need to, the annual expected value for losses, we're going to reduce this by $16,000. Essentially, that's insurance costs. If you want to look at it that way, is that they're going to retain the cost that they need to set aside $16,000 a year for expected of what they might expect to have a fire loss. And so they're going to set that money aside for that. And so that needs to be deducted from the $60,000. So before tax, our net cash flow is going to be $44,000 a year. So we go $44,000 a year. Now what we need to do is we need to figure out after taxes, what does that look like? Well, we had $200,000. We know it's going to have a 10-year useful life that they've given the money, so $20,000 a year. So 44,000 minus the 20 is $24,000. Now, what's that 24,000 at a 40% tax rate? And we end up with $9,600. So we now take that 44,000, that before next tax net cash flow, subtract our income taxes, and so after tax net cash flow is $34,400. So again, typically you're going to have a problem, and you're just going to have to solve this piece of the problem uh, on the exam. You're not going to have to do both, but they may have some other information they provide is for doing the second piece, so just in case you get the first one wrong. So now to calculate whether this is a good investment, so initial investment, again, $200,000. Life of the project is 10 years. Annual after-tax net cash flow, we just calculated $34,400. Now our minimum acceptable rate of return is 10%. So if we go the present value of our 34,000, 10% over 10 years is 6.145, which means our present value of 211,000. We subtract that initial investment, and and what we come up with as a net present value of 11,388. So that gives you an idea of how you do this type of problem. Now, what they do in here is in the book, they also throw out this idea of, okay, that's just by doing that. Well, what if we required as part of the $200,000 that they install a sprinkler system to reduce the potential loss of or fire losses? And so again, we come up with, if we do that, our probability of fire remains the same, but the potential damage is significantly less, right? So whereas we saw before, 30,000 or 200,000, they're about cut in half here. We come up with an expected value now of about $4,200. And it talks about on here, the sprinkler system initial cost is added to the cost of proposal. And we also now need to depreciate that. So again, going back to the table here, what we put together, we have the $60,000 that was our expected cash flows, but now we have that $4,200 in losses, our expected losses that we're going to subtract. But we also now, they've thrown in there, it's going to cost us with the sprinkler system about $400 a year to maintain that. So we need to subtract that from our cash flows as well, which makes us ends us with $55,400. Now we do the tax calculation again, right? Now, if you notice, it's $210,000 is our initial outlay, because besides the initial grant, that's $10,000 for the sprinkler system. We still have that 10-year straight line depreciation. So that's $21,000. We subtract that, and again, the 40% times the 34,000, and we come up with an after net tax net cash flow of 41,640. And we do the same thing over 10 years, right? Except in this case, it's 41,640 times the 6.145, the 10% over 10 years. And we can show that basically by doing the sprinkler system, by adding that, it reduces our risk, right, of potential fire. And essentially by having the 210,000, we actually have a net present value of $45,000 compared to our 11,388. So over a period of time, by doing the sprinkler system, it actually does have a much larger savings to basically be able to install that type of system. So that's how you want to do these problems. There's plenty of practice that you're going to find on the website on the supporting materials, and I encourage you to take a look at those as well. So we went through all the net present value stuff, and we'll do some more practice here. But the last piece in the text that they talk about is call options and how do we limit financial risk. And really the way to do that, especially when we're talking about, in the agriculture industry, things like that, is using contracts or a forward contract. And what that does is it's a contract that obligates one party to buy and another party to sell a specific financial instrument or physical commodity at a specified future date and price, right? So again, we're probably used to seeing this from on the agriculture side, or on fuel would be a contract. And really what we're trying to do is we're hedging our bets, right? We're hedging a business risk, and we're trying to stabilize pricing and risk by doing a contract when we use this type of tool. So in the textbook, they have a couple pages on this. There's a lot more practice in the supporting materials, but you are just going to need to do some basic calculations on this, and this is going to be fairly simple to do when you go through it, but we'll just kind of go through this basic case fact that we have in here. So in this case facts, Millwright Food Products Company, so we're just going to call it Millwright, produces baked goods that it sells around the United States. Wheat and the flour made from the wheat are necessary ingredients to make its products. Millwright's ability to earn net income depends heavily on the prices it must pay for its ingredient, especially the wheat. So the price of wheat changes over time, and Millwright's management is uncomfortable with a swing in the company's monthly net income that results from a change in the price of wheat. To smooth the largely unpredictable fluctuations in wheat prices and its monthly operating results, Millwright is considering hedging the business risk through use of a call option. So again, this is something fairly common is prices, things that fluctuate. And you think about oil prices, you see them go up and down. The idea is if they buy a futures contract, they know what the price is. That reduces uncertainty. And that's what we're trying to do in risk management, reduce uncertainty. They may not make as much money, potentially if prices dropped, or they had a benefit from a lower wheat prices, but they at least get that stability in doing so. So here's the facts needed to calculate the effect on net income of a call option that offsets input price increases for this company. So essentially the facts needs an average of 10,000 units of wheat each month. Current market price of wheat is about $3. The strike price, or the price set in call option contract of a unit of wheat, is $3. Okay, so that means an option. It'll basically the call option is at the $3. The call fee, which is a commission earned by the brokerage handling the purchase and sale, is about $300. The purchase price of the call option contract is $5,200. The selling price of a call high is $15,200, and the selling price of a call low is $0. So you're going to have something that looks like a table like this, or information that you put in there, and essentially this is just trying to show you what hedging does, and it talks about the calculations, and it's really you're going to have to look at what the savings are on here when they ask a question of calculate the effect on an income of a call option offsets input price increases. And so they give some information, and you'll need to just look at, subtract one of these numbers of that they're by doing, if they stay the same, it's 11,000, that's $5,000. If wheat prices fall, they make $5,000 more, those type of things. It's going to be fairly easy math, but you just need to be able to read the table. So how we want to read this is what it says is sales, what they expect. This is consistent all the way through, 100,000 in sales, 3,000 other income, whatever that may be, and that the total revenues that they expect are $103,000, right, based upon this. The expenses, wheat flour, is $30,000. Now that's based upon, if you remember correctly, 10,000 bushels at $3, and so essentially that's where the 30,000 comes from. Other expenses, and this stays the same, 62,000. That may be their labor, and total expenses based upon this is 92,000, and net income of 11,000. So the main thing that changes on each one of these is really going to be the expense area, right? So everything's the same up here until we get to the price of wheat flour. So this is the thing that's fluctuating at $2.50. At 10,000 bushels we need to buy, wheat costs us 25,000, and so our total expenses are reduced, and so we actually make a little bit more money that month of 16,000. If prices increase by 50 cents, or excuse me, $1, our prices, our costs obviously increase dramatically, and we see $1,000 net income. So that's without doing any hedging. And what they're really showing on below is all these things are pretty much the same, except for the net income on a call option. If prices increase, they're going to have some stability. They're going to get $10,000 by calling the option. That's what they're essentially doing there. And so the total revenues would actually increase. On this part, on the expenses, again, we see that for the most part, the expenses are the same as what we saw above. The other expenses are exactly the same. We've inserted a call fee, right? Because they said since we bought this option, if we have to call it, there's going to be a fee associated with it. So we have a $300 call fee as part of it. The loss on the call option. So we're going to lose $1,500 by doing the option right there. And then, so our total expenses, you can see where that comes into play, and a net income of $5,500, $10,500, and $10,700. So what this has essentially done is, while wheat prices, if this is the normal price is $3, if prices go up, rise, we would actually make more money because we've hedged our bets. We have a contract that we're still going to pay we're going to be paid essentially, where is it, the $10,000 to as part of the income on the call option. But if you look over time, whereas we have a lot of fluctuations here, what this is providing some stability. And the idea is if the prices just stay the same, but if they go up or down, we're actually going to increase our revenue by doing so. That's the whole idea of the call option or the hedging. And it's going to be simple math of basically some subtraction of based upon what price and those type of things you're going to have to look at. And again, there's some sample problems in the book with that. So with that, there's a couple problems I kind of put in here that you can certainly take extra practice. So Maria has a table listing the present value of factors from $1 received at the end of each year for 4 years, shown in the below. She needs to calculate the present value of a stream of 4 equal payments of $5,000 received at the end of each of the next 4 years. The discount rate is 8%. What's the present value and how do we get there? And so based upon the table, right, the 3.13 times the 5,000, again, that's where we're going 4 years, 8%. That's how we use the table. Now, on this problem, you can also figure out, just without even doing any calculations, does it make sense, right? What's the present value of the stream of payments? Well, if we're getting 4 equal payments of 5,000, we know A is not the answer. And 5,000 times 4, even if we did basic, that'd be $20,000 without the discounting. So we know 42 and 66. So even if you didn't do the calculations, you should be able to figure out that this one makes the most sense. And you will have problems like that to where you can just look at it and realize that none of the other answers make any sense as part of that. Propose this one, initial investment, kind of the same thing. Propose initial investment of 60,000 will have a useful life of 4 years with no salvage value and generate a differential annual after-tax net cash flow of 20,000. The minimum acceptable rate of return is 10%. Which of the following correctly evaluates a proposal using net present value? Right? And so where this comes into play is the 20,000, right? Or, excuse me, make sure I got this right. Minimum acceptable rate of return is 10%. So the net present value is 3,400. So the acceptable, so it is acceptable by the net present value method. And all that we're doing on here is a 3.17 times the 20,000. And if we do that, it actually, whatever the number comes up with is 63,400, because you're taking the initial investment or the 60,000, and when you multiply it, that's the number you're going to come up with. So it has a positive cash flow of the 3,400. Some of these others, these are things you can basically go through on some of the sample questions. Again, a lot of these are coming from the sponsor's guide on there, so you can look at some of these answers on here as well. So another example, Pinewoods Manufacturing management team is evaluating a proposal to build an addition to the plant. The net present value and IRR, internal rate of return, the proposals are less than they anticipated. However, the company's risk manager explains the installation of a sprinkler system in the building can make the proposal more attractive. All the following are correctly describe the effect of the sprinkler system on the proposal net cash flow, except, right, the sprinkler would reduce the expected value of fire losses. B, the maintenance expenses for the sprinkler system would be added to the cost of the proposal's initial investment. C, the system's initial cost would be added to the cost of the proposal's initial investment. And D, the depreciation expenses for the sprinkler systems are considered in calculating after-tax net cash flow. So all these are true except for, and if you think about it, it would be B, because maintenance expenses are an annual thing, that it's not going to be something part of the initial investment, and so that would be why that answer is correct. I just put some other type of things in here to help you out, some for memorization on financial principles and some other problems. And again, you can do that and calculate some of those on there. There's part of this is for those on the safety side of the house that did taking a CSP. These are engineering economy questions or formulas. But so this is, if you're used to using that, here's also a way you can solve the problem by using some of those as well. So with that, we will end tonight's class. Again, take advantage of the supplemental materials. This is the chapter that most people have struggle with. At the same time, if you're taking the entire chapter, or excuse me, taking the entire exam, you're not doing segmented, and this is the one chapter you bomb, it's okay. I've seen people bomb this entire chapter, pass everything else, and do just fine. So we'll sign off with that. Look forward. We have our last chapter next week, and then we'll do a final summary session of all the chapters the following week. Thanks again. Have a great night, everyone.